Premiums for inclusive insurance business need to be sufficient to cover the claims and expenses of the business, as well as to generate a profit for the insurer. If there is an increase in the claims or expenses, then this will reduce the profits and may even result in the business making a loss. It's difficult to determine whether the premiums will be sufficient at the time of pricing a new product, particularly for inclusive insurance business, where there's little data on the claims experience and little information on the characteristics of the customers who may take out the products. It's very important, therefore, for the insurer and the supervisor to monitor the claims and expense experience of the business over time, and then to determine whether any adjustments to the premiums might be required. Three main ratios can be used to monitor the financial performance of inclusive insurance business: the claims ratio, the expense ratio, and the net income ratio. The claims ratio is the total amount of claims relative to the premiums that have been received. A high claims ratio may indicate that inclusive insurance product is not viable, for example. If the claims ratio is 80%, this means that 80% of the premium goes towards paying claims and leaves very little of the premium left over to pay for expenses or to generate a profit for the insurer. Claims experience might be high due to adverse selection. This is particularly relevant for health insurance business, where customers who know that they're experiencing certain health problems may take out health insurance and then claim for those conditions within a very short period. This results in high claims to the insurer, higher than they expected. There could also be instances of claims fraud, where customers claim for visits to the hospital using fraudulent medical certificates. It's important, therefore, for the insurer to identify the causes of poor claims experience and then put measures in place to manage that risk. The expense ratio gives an indication of the total expenses relative to the premiums for inclusive insurance business. A high expense ratio means the business will struggle to be viable. If the expense ratio is, say, 50%, this means that 50% of the premium goes towards paying expenses. There's very little left over to pay for claims and generate a profit for the insurer. This can result in products not being viable and also the product not being very good value for money for the customer. Inclusive insurance business generally has low premiums, so that the business can be affordable to the low-income market. This means the insurer needs to be very efficient in managing its costs to ensure the business is viable and generates profit. Finally, a negative net income ratio indicates the business is making a loss. In this case, the insurer would need to put measures in place to manage its expenses and claims experience. This may allow the business to become viable in the future. When looking at these ratios and what an acceptable range or level for them might be, it's important to consider the type of business that's being written and how long the product's been available in the market. We might find certain types of product and business models have a generally higher claims or expense ratio. So, for example, health insurance business tends to have higher claims ratios compared to personal accident business, and business sold through individual sales agents might have higher sales expenses relative to business sold through microfinance institutions. So there may be variations in claims ratios and expense ratios based on the type of business. But there still is a need to establish an acceptable range for these ratios to ensure the business is viable. When looking at the financial performance of the business, we find there are high initial costs when introducing new products. Large investments are required in terms of the design of the product and setting up systems, and it may take a long time to recover these expenses from the business. We also know that inclusive insurance business requires that insurers sell a large number of policies to be able to cover these costs. If the product's relatively new and it's only been in the market for a short time, there may only be a low policy volume, and the insurer might not be able to cover its costs. But as the business grows over time, the business may become viable as policy volumes increase and costs per policy reduce. So it's important to bear in mind how long the product's been in the market when assessing the viability of the product, and whether the ratios of the financial performance of the business are at an acceptable level, or whether they can be expected to move to become acceptable.